Hi, welcome to EQD Research Global Insights for Friday, non-farm payroll, June 5th. Today, going to take a look at how volatility expectations have dropped in reaction to the non-farm payroll number, not just in the US, in Europe as well. So let's start out in Europe. The Euro Stoxx 50, about 0.3%, 40.90 as I sit here. It did move higher after the non-farm payroll numbers. Nice little move higher using the 5-minute chart. VStoxx down about 90 cents to 17.30. VStoxx was at about 18 when the payroll number came out. June's down 90 cents as well to 18.15. Only an 85-cent premium there. Narrower premium in the VStoxx complex than in the VIX complex. We'll see that in a second. And then July is lower as well to 1965. Now, yesterday I went looking for some block trades that maybe were put on in front of the non-farm payroll number. Came across a ratio put spread. Somebody sold 3,500 of the June 19 puts, bought 7,000 of the June 17 puts. The net credit on this trade was 62.5 cents a spread. VStoxx was at 19.25 when the trade went off, and the June contract was at 19.50 when the trade went off. Now, the worst case scenario here is VStoxx at 17 at expiration and a loss of $1.37.5 per spread. Right now, just checking in on the pricing with VStoxx lower and actually pretty close to that short strike of 17. You could sell those puts at 45 cents each. You would have to buy back the short 19 put, and it was offered at $1.90. So right now you could pay $1 to get out of the trade. You'd have an unrealized loss of 37.5 cents. But if VStoxx continues to trend lower, this trade could pay off quite handsomely. Or if something happens and we have a volatility event and it goes back up, both options could expire with no value, and the profit would be equal to the 62.5 cent credit when the trade was put on. I doubt that they put this trade on with the intent of taking it off today. Just wanted to point out the unrealized position based on the markets today. So turning to the US, the S&P 500 is up 0.7% to 42.23. VIX is down $1.60 to 16.45. June's down $1.25 as well at 18.05. That's a $1.60 premium to spot. As I noted, the VStoxx premium is much narrower relative to the VIX premium. July is down 1 point to 20.40, but that is almost a 4-point premium relative to spot. When I see a steep curve that involves the front couple of months, I go looking at the offer prices on the various puts. Now, keep in mind, the put options that expire in July are priced off of the July futures, but they do settle in a calculation of spot index. So here are the offer prices this morning for all of the July puts, with strike prices from 20 up to 30. Starting at the very top of the table, I'm not going to go through every one, but you could buy the July 20 put for $2.70 right now. The break even at expiration is 17.30, and that is 85 cents higher than where spot VIX is as I sit here. Up at the 30 strike, you can pay $11.10 for those. The break even is 18.90. That is $2.45 higher than where spot VIX is right now. Now, I typically put these trades on and then I wait until we get close to July expiration in this case, and I'll take a look at maybe selling an at-the-money put as the future gets closer to the index, taking in a little bit more premium, and maybe even trade around this position a little bit as well. But did take a long position in one of those puts, and I'll share more as we go along up to July expiration about how I'm trading around that. So thanks for joining me for EQD Research Global Insights for June 5th. If you've got any suggestions, feel free to leave those comments below in the comment box. If you stuck with me this long, the rule is you have to hit the like button. That's the cost of watching the video. Again, I'm open to suggestions. If you got something more extensive you'd like me to talk about, feel free to shoot me an email at rhodes@eqderivatives.com.